Should diversify. A lot of the people who have come into the equity markets, especially retail guys who have come in the last 2, 3 years, uh, they seem to have too much allocation to one kind of product alone, which is a vanilla long product. Uh, Debt has not really kicked off in India. With interest rates going up like they are, government securities, tax-free bonds, national highways, Indian railways, a lot of this debt has become reasonably attractive. And I think one has to split the investment corpus between debt, between equity, add some gold in the portfolio, which acts traditionally has acted as a great hedge against inflation. So that would be my recommendation to all. Like, take differentiated products which have exposure to different asset classes. Like even Kubicon, for example, by virtue of the hedging component, is very diversified. But don't keep levering up, or don't keep like allocating 100% of your money to one single product, which is vanilla equity. Because then if the markets were to correct, and markets are cyclical, right, Charlie, in every decade, every 5 years, they will go down, they will go up, and that is the nature of the equity markets. So my advice would be get that diversification. Um, we should not. I think an investor does so much better when he doesn't look at the market from a 1 year or a 2 year perspective, aiming to make as much as they can, but more from a 10, 20, 30 year perspective. And the age group that most new retail investors are coming in at today, the 20-year-olds, I think they can afford to have that perspective. So plan in that way and not for the very short term future. I Because of the position that I sit in as somebody who is part of a asset management business, I need to at some level be able to tide over short term spikes in volatility which might occur. So tomorrow, if there is a 20% correction, I can't go back to my investors and we're down 20%. I think even for them to plan their savings and their investments, they like the fact that they have some kind of insurance here. So if the markets fall 20, we're only down 8% or 9%. For those reasons, I need to time the market a little bit, or attempt to, because nobody, I think, can truly do it in a way where one can, claim that they do it accurately. But for a retail investor, I think it's a different story. And for a savvy investor like a HNI or ultra HNI, I think this diversification that I was talking about adds immensely to their portfolio. Be cognizant to all that is happening in the world, and uh, get into a more hedged, diversified investment portfolio versus being 100% long equity. In the short term, you shouldn't sit and compare it with somebody who's levered and taking on a lot of risk and making 15% when the markets are up 10%, because that is bound to happen. But from a long term perspective, I think this diversification will help people a lot. New guys who came in the last couple of years, I think this is very targeted advice, but diversify. Keep a lot of equity, but add some gold, add some debt into that portfolio. If you approach the market trying to make 50% a year, the odds that you're going to lose money is probably 80%. Uh, be reasonable. If you put your money in a bank, you get 7% or 6%. Try to build strategies which give you 12%, 15%. The power of compounding is incredible. If you can make uh, consistently small amounts of money, before you know it, compounding will take that portfolio elsewhere.